have now learned the key concepts of policies, provisions, options, and riders. Let's review some of the key areas from this section that will help you prepare to pass. Term life. Term life insurance is temporary life insurance provided for a specific period of time. It is also known as pure life insurance. Term insurance is temporary protection because it only provides coverage for a specific period of time. Term policies provide for the greatest amount of coverage for the lowest premiums. Term insurance provides what is known as pure death protection. If the insured dies during the policy term, the policy pays a death benefit to the beneficiary. If the policy is canceled or expires prior to the insured's death, nothing is payable. With term policies, there is no cash value or any living benefits available. There are three basic types of term coverage: level term insurance, increasing term insurance, and decreasing term insurance. Level term insurance is the most common type of temporary protection. The word level refers to the death benefit that does not change throughout the life of the policy. Decreasing term policies feature a level premium and a death benefit that decreases each year. Decreasing term policies are primarily used when the amount of protection needs to decrease over a period of time. The most common use for a decreasing term is to ensure the payment of a mortgage. The policy amount decreases as the outstanding mortgage loan balance decreases each year. In a decreasing term policy, the death benefit will be $0 at the end of the policy term. Increasing term policies feature level premiums and a death benefit that increases each year. The amount of increase is usually set at a specific amount or percentage. Special features of term policies. Most term policies are renewable, convertible, or renewable and convertible. Renewable. A term policy that is renewable allows the policy owner the right to renew the coverage at the expiration date without evidence of insurability. The premiums for the new term policy will be based only on the insured's current attained age. Convertible. A term policy that is convertible allows the policy owner the right to convert the coverage to a permanent whole life insurance policy without evidence of insurability. The premium for the new whole life permanent policy will be based only on the insured's current attained age. Whole life. Also called permanent life insurance, these are policies that remain in effect to age 100 as long as the premium is paid. Whole life insurance provides lifetime protection and includes a savings element known as cash value. Whole life policies endow at age 100, which means the cash value created by the payment of premiums is scheduled to equal the face amount of the policy at age 100. Premiums for whole life policies usually are higher than those for term insurance. The following are key characteristics of whole life insurance. Level premiums. The level premiums for whole life policies are based on the age of the individual when originally purchased. Therefore, the premiums remain the same throughout the entire life of the policy. Level death benefit. The death benefit is guaranteed and remains level for the entire lifetime of the policy. Cash value. The cash value created by the accumulation of premiums is scheduled to equal the face amount of the policy when the insured reaches age 100. Living benefits. With a whole life policy, a policy owner can borrow against the cash value while the policy is in effect, or can receive the cash value when the policy is surrendered. Cash value is also referred to as non-forfeiture values. The three basic types of whole life insurance are straight whole life, limited pay whole life, and single premium whole life. Straight whole life, also called continuous premium whole life, is a basic whole life policy where the policy owner pays a fixed premium for the time the policy is issued until the insured's death or age 100. Limited pay whole life. Unlike straight life, limited pay life is designed so that the premiums for the coverage will be completely paid up well before age 100. Most versions of limited pay life are 20-year pay, whereby coverage is completely paid for in 20 years. Or life paid up at 65, whereby the coverage is completely paid up by the insured at age 65. Single premium whole life. With a single premium whole life, a one-time lump sum payment is made. which will provide a level death benefit to the insured at age 100. The policy is completely paid up and will generate cash value immediately. Rights of ownership. The assignment provision specifies the policy owner's right to transfer ownership of the policy. There are two types of policy assignments. Absolute assignment. Absolute assignment involves transferring all rights of ownership to another person or entity. It is a permanent and total transfer of all the policy rights. The new policy does not need to have an insurable interest in the insured. Collateral assignment. Collateral assignment involves a transfer of partial rights to another person. This is usually done in order to secure a loan. A collateral assignment is a temporary assignment. Once the debtor loan is repaid, the rights are returned to the policy owner. Standard policy provisions. While there is not a set standard of policy provisions in life insurance, the standard policy provisions adopted by the NAIC, National Association of Insurance Commissioners, does create uniformity amongst life insurance policies. Entire contract provision. The entire contract provision stipulates that the policy and a copy of the application, along with any riders or amendments, make up the entire contract. Insuring clause. The insuring clause is the company's agreement and promise to pay the death benefit. Consideration clause. The consideration clause is the policy owner's promise to make premium payments. Free look provision. The free look provision allows the policy owner a free look at the policy for a specific number of days. The free look period starts when the policy owner receives the policy from the insurance company in the mail or is delivered by an insurance agent. Grace period provision. The grace period is the period of time after the premium payment is due. The grace period is usually 30 days. The purpose of the grace period is to protect the policyholder against an unintentional lapse of the policy. If the insured dies during this period, the benefit is payable. However, any past due premiums will be deducted from the death benefit. Reinstatement provision. The reinstatement provision allows a lapsed policy to be put back in force. If the policy owner elects to reinstate the policy, they will have to provide evidence of insurability, pay all back premiums with interest, and may be required to repay any outstanding loans. Policy loan provision. The policy loan provision is found only in policies that contain cash value. The policy owner is allowed to borrow an amount equal to the available cash value. If there are any outstanding loans at the time of the insured's death, the death benefit will be reduced by the amount of the outstanding loan. Incontestable clause. The incontestable clause prevents the insurance company from denying a claim because of incorrect information or a concealment of facts after the policy has been in force for 2 years. Suicide provision. The suicide provision of a life insurance policy protects insurance companies against people using suicide for a quick payment of the death benefit. If the insured commits suicide within the first 2 years, the insurance company will not pay the death benefit. They will only return the premiums that have been paid. Misstatement of age or sex provision. Because the age and sex are important factors in figuring the premiums that will be charged for a life insurance policy, this provision allows the insurance company to adjust the policy at any time due to a misstatement of age or gender. In the event of a claim, the insurance company is allowed to adjust the death benefit or the premium to correct the age or gender. Automatic premium loan provision. The automatic premium loan provision is commonly added to contracts with cash value at no additional charge. This is a special type of loan that prevents the unintentional lapse of a policy due to the non-payment of premiums. For example, if a policy owner misses a premium payment, the payment is automatically paid using the policy's cash value. Exclusions. Exclusions are the types of risks that an insurance policy will not cover. The most common exclusions found in life insurance policies are war, aviation, non-commercial pilot, hazardous occupation or hobbies, commission of a felony, and suicide. Non-forfeiture options. Because permanent whole life insurance policies have cash values, certain guarantees are built into the policy that cannot be forfeited by the policy owner. So basically, if a whole life policy has cash value and the policy owner wants to surrender the policy because he does not want it anymore, he must make a decision on what he would like to do with his cash value. The three options are cash surrender, reduce paid up, or extended term. Cash surrender option. Very simple. Take the cash. Reduce paid up option. Under this option, the cash value is used to purchase a paid up whole life policy. The new whole life policy will have a smaller or reduced face amount from the original policy, but there will not be any more premium payments due, and it will continue to gain cash value. Extended term option. Under this option, the cash value is used to purchase a term policy. The new term policy will have the same face value amount as the original whole life policy and will last for a set period of time based on the amount the cash value available used. And there will not be any additional premium payments due. Dividends. Dividends are paid only on participating policies. When the policy owner purchases the policy from a participating insurance company, they are eligible to receive dividends. When receiving dividends, they have the following 5 options. Take dividends in cash, apply dividends against premium payments, allow dividends to accumulate interest, buy paid up additions, which is a whole life policy, and purchase 1-year term insurance. Policy riders. Policy riders are added to a policy and ride along on the basic life insurance policy. Riders only have value when attached to a policy. They have no independent value. They are added to help people customize their insurance policies for their individual needs. Unlike policy provisions, policy riders are not free. Their cost is added to the life insurance policy premium. Guaranteed insurability rider. The guaranteed insurability rider allows the insured to purchase additional coverage at specific future dates without the evidence of insurability. The new premiums will be calculated only on the person's attained age. Waiver of premium rider. The waiver of premium rider waives the premium for the policy if the insured becomes totally disabled. Most insurance companies impose a 6-month waiting period from the time of disability. The coverage remains in force until the insured is able to work. If the insured is never able to return to work, the premiums will continue to be waived by the insurance company. The waiver of premium rider usually expires when the insured reaches age 65. Cost of living rider. The cost of living rider addresses inflation by automatically increasing the amount of insurance without evidence of insurability. The face value of the policy may increase by the cost of living factor tied to an inflation index such as the Consumer Price Index. Fully understanding these key topics are essential as you prepare to pass.